What does properly structured IUL mean?
The interest you're earning on these millions of dollars of cash value compared to the net amount at risk is dwarfs the actual cost. This is why the older you get, the less expensive it becomes if it's properly structured.
If you don't understand the difference and you're interested in taking out an IUL, or if you're an advisor, you can't believe how many advisors don't know the difference and why this is so crucial for their clients. Get ready. This will enlighten you, and I think it's going to blow you away. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of people optimize assets, minimize taxes, empower their authentic wealth, prepare for a comfortable retirement where they will not outlive their money due to the negative impact of taxes, inflation, and market volatility. Without question, the best financial vehicle that eliminates those 3 dangers, taxes, inflation, and market volatility, is a properly structured, maximum funded indexed universal life. If it is properly structured and maximum funded, it is deemed a laser fund, okay? Meaning that all laser funds are indexed universal life, but less than 0.1% of indexed universal life policies that are sold would qualify to be a laser fund because they are not properly structured, okay? So let's get down to the nitty gritty here so that hopefully you'll understand this. And if an agent is trying to talk you into it, or if you're an agent, you'll learn what we're talking about here. Okay. Properly structured maximum funded IUL usually refers to indexed universal life that's being designed, is being taken out by the client for the primary purpose, objective, of tax-free accumulation and tax-free income down the road. They want to use it while they're alive. It's not the death benefit. Okay, most people came to me not necessarily wanting or needing life insurance, even though they're thrilled when they get this death benefit coming along for the ride, that because I properly structured it, the insurance is being paid for with a minuscule portion of money that would otherwise go out the window in unnecessary tax. See, we don't object to insurance benefits, we object to paying for them. And the way I would structure them, nothing's free, but they weren't paying for the insurance. Uncle Sam was paying for it, so to speak, with a portion of money that I was saving them in income tax. If you're going, what are you talking about, Doug? Okay, I'll just cut to the chase. See, most people who would come to me, they realized if they studied my book, that they would have to be earning 15 or 16% in a tax-deferred IRA or 401k in the market, which means they're taking some high risk to do that. But they would have to earn 15 or 16% to net 9 or 10 after tax at the end of the day on their money in the market, and that's volatile because Wall Street was not designed to create predictable income. And so I'm saying, you know what, if you maximum fund an IUL, you only have to earn 11 to net 10. With the tax-deferred IRA or 401k, you have to earn 16 to net 10 because in a 33% bracket, you have to earn 15 to net 10 because if you had $1 million nest egg, you have to pull out $150,000 a year to net $100,000, a net of a 10% payout to buy gas and groceries, prescriptions, and golf green fees. But there's another 1% in asset management fees. So you're not netting 10, you're netting 9, okay? But see, the financial services industry standard is the 4% rule. You pull out $40,000 and you only net $30,000 in a 25% bracket because you have to pay $10,000 in tax. But if the advisor is charging you 1% on $1 million nest egg, that's $10,000. And so if we go back to the example, you'd have to earn 16% after taxes and a 1% asset management fee to net 10. With IUL, I only have to earn 11 to net 10. Well, what's that 1%? It's the cost of insurance that the IRS says has to be there or it would not be tax-free. And it's really not a cost, it's a benefit, because at the end of the day, when they do pass away, anything left behind in a max-funded IUL is going to blossom, it's going to increase in value and transfer tax-free. But it's money that would otherwise go out the window in unnecessary tax. Does that make sense? I'd have to be earning 15 or 16 to net 10. Here I only have to earn 11 to net 10 That's 1%. It's a minuscule portion of the money they would otherwise have to pay out in tax. That's what I mean by that. So it's critical to make sure you properly structure an IUL. So let's get back to the scenario. If your objective is primarily living benefits, to accumulate money tax-free at the best and highest net internal rate of return, and to be able to accumulate for every $1 million, generate a 10% payout, let's say $100,000 a year tax-free income. If that's your primary objective, then you take the least amount of insurance the IRS will let you get away with. And frankly, that was the brainchild of E.F. Hutton when Universal Life was first introduced in 1980. They basically said, what are we thinking? Here's this incredible vehicle in the Internal Revenue Code, permanent life insurance. But whole life did not do very well. The rate of returns weren't that great, and you had to have so much money into it in order to have these guarantees. But if you can make the cash inside the policy grow to where within 10, 15 years, the cash value equaled and exceeded the death benefit, now this was like buy term, invest the difference on steroids. There's a lot of agents that don't understand. This is why whole life agents go, universal life is gonna crash and burn. It gets more expensive as you get older. And I just roll my eyes. I go, they don't know what they don't know. No, you're self-insured usually within 15 years with a properly structured IUL. If you're older, and you're maximum funding it within 5 years, because the actual cash value will grow to equal and exceed the original death benefit. Now the insurance, you're self-insured. If you happen to die, they're going to pay out 5% more than that, but that's minuscule. The interest you're earning on these millions of dollars of cash value compared to the net amount at risk is dwarfs the actual cost. This is why the older you get, the less expensive it becomes if it's properly structured. Okay, so how do you do this? When you're opening up an IUL policy, and let's say you're 60 years old and you're a male and you want to reposition $500,000. Well, you can't put in $500,000 in one fell swoop like you could in the early 80s. The law changed June 21st, 1988. They wanted to slow the flow. And the banks and the brokerage firms couldn't compete, and so they wanted to slow the flow of money that was leaving their institutions into these, because these are safer, they pay higher interest, they're tax-free, and they blossom when you die. Money in a bank or credit union or a brokerage firm, a mutual fund doesn't do that. But they didn't want to kill this, because this is where they put a lot of their money, okay? And so under the TAMRA tax citation, Technical and Miscellaneous Revenue Act of 1988, if I have a 60-year-old that wants to reposition $100,000, the most they could put in would be maybe about $100,000 a year. So if I know that information, $100,000 a year, they can get in their $500,000 in 5 payments. Okay, $100,000 the first day of the first year, $100,000 the first day of the second year, but actually the fifth year. The first day of the fifth year, if they did that, is actually 4 years and 1 day into the contract. Now they've complied with the IRS TAMRA tax citation, and now they've put in their $500,000. Now, I know that if I go into the software, I can calculate what's the least amount of insurance I can get away with, and under Section 7702 now, it's about double that. It's $1 million. I could buy way more life insurance than $1 million with $500,000. That's not the objective. You want the least amount of insurance. So I would take $1 million death benefit. And when I put in $500,000, now $500,000 of that million is my own money. They're only charging me for the difference. As that $500,000 doubles in 7.5 years on the average to equal $1 million, now the net amount at risk is zero. But if you die, TEFRA and DEFRA tax citations say the insurance company will pay out 5% more than your cash value, which is now greater than the original death benefit. It's tax-free as it transfers. But see, you're actually making the insurance policy get cheaper as you get older. That's what a properly structured policy will do. You're taking the least amount of insurance. So what's the biggest mistake I see people make? IUL agents who don't know what they don't know, or they rely on people creating illustrations for them at their marketing organization or the insurance carrier, and they create illustrations and they don't know how to do this. So let me give you a prime example. Let's say the agent says, well, I have a client that wants to put in $500 a month, and but they have this lump sum of $60,000 they want to put in the first year. Now, an agent who doesn't know what they're doing, and these clerical people, what they do, they want to avoid a modified endowment contract. So in order to accommodate the $60,000 one-time lump sum up front, they jack up the life insurance death benefit so that it doesn't become a modified endowment contract. They don't violate TAMRA. And then the client pays target premium after that, $500 a month, which is $6,000 a year. And then they wonder why, if they were earning 6, 7, 8, 9, 10%, they're only netting 2 or 3%, even after the policy's been in force for 10 or 15 years. They're going, how come my cash value hasn't grown to equal or exceed the death benefit? It's because you jacked up the death benefit so high to accommodate the $60,000 lump sum on the front end. That's the biggest mistake we see agents make, or the clerical people running the illustrations. Oh, I know how to do this. And so they increase the death benefit to accommodate the $60,000 one time up front, and then the client puts in a target premium thereafter. That's a recipe for disaster. And I've seen it thousands of times. We have to correct those mistakes, okay? Now, simply put, if somebody has a one-time lump sum of $60,000 on the front end, and the subsequent premiums after that they plan on paying are $6,000 a year, $500 a month, okay? $6,000 a year is, in the first 11 years under TEFRA and DEFRA, $66,000. And the death benefit only needs to accommodate that $66,000 plus another $60,000. But what did they do? Okay, in that case, you would be calculating a death benefit based upon $60,000 plus another $66,000 over the first 11 years. What is that? That's $126,000. That's a much different death benefit, taking the minimum death benefit, than to try to accommodate $60,000 the first year and another, $6,000. So that's $66,000, because if you took the death benefit to accommodate that, it's the death benefit assuming you're going to put in $66,000 a year the rest of your life. What? 66,000 times 11 years requires a death benefit that is enormous. The solution? You take the lower death benefit and you spread out the 60,000 lump sum over the first 5 years. You're only going to put in $12,500 a year for the first 5 years. Not all 60,000. You keep it parked somewhere or something, unless they're going to put in a lump sum later. That's the biggest mistake we see. And so what I mean is that if you have this big death benefit, to accommodate the first year, and then you pay target premium thereafter, it's a recipe for disaster. Because not only if you don't understand that, you probably don't understand rebalancing and how to diversify. You'd be lucky to earn 7 or 8% gross on that IUL policy average, but you'd only be netting 1 or 2%. It's horrible. If you understand these kinds of things, then you know how to rebalance and diversify each year. You'll increase probably the chance of earning an average return from 7 or 8% up to 10 or 11%. But if you earn 11, you'll net 10. If you earn 10, you'll net 9. If you only earned an average of 8, you'll net 7. If it's not structured properly, and you were lucky enough to earn 8, you'd be lucky to net 1 or 2. That is a huge difference. And when we actually show this, you can't believe how many people just go, oh my heavens, I shouldn't have just trusted my brother-in-law or my nephew or my friend, because they told me they were licensed and they had the illustration prepared by the clerk at the home office. I can tell you right now, 99.9% of IUL policies are not structured properly to do what I'm talking about here. So this is huge. If you want to learn more and you're a member of the general public and you're checking out an IUL, don't make the mistake of having somebody do it wrong. I would recommend you make sure that your agent is certified as an IUL professional, And that's why I created an organization called IUL Insiders. And in that group, we have a certification class. It's not easy. You have to pass a proficiency exam with 100%. There's 100 questions. Most advisors wouldn't even understand 80% of the questions. So if you're a member of the general public, this is my recommendation. First of all, claim a free copy of this book. You read this book and you'll know more than 99.9% of insurance agents do, even those selling IUL, about how to properly do this, okay? And so you can go on Amazon and buy it for $20 plus shipping. I'll gift it to you free. You simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that and I'll pay for the book. I'll fire out a hard copy to you via priority mail. If you like to listen and learn or watch and learn, there's audio and video options there. But you can actually go in and schedule an appointment to talk to an IUL certified professional who knows how to do it right, and they'll show you the difference in an illustration of a properly structured one versus probably the illustration you got that was done wrong, okay? You'll be flabbergasted. We've done this thousands of times. So if you're a member of the general public, talk to an IUL professional that's certified. No cost, no obligation. But if you're a professional watching this video, I would strongly recommend you learn how to do it right so that you're not doing your clients a disservice. And so check out IULinsiders.com. I think you ought to belong and begin to learn terminology like this, but then you ought to get certified. Because if you're not, in my opinion, you have no business selling IUL to individuals who want to use it for living benefits. If all they want is a death benefit, maybe you're okay. I'm even nervous about a lot of agents don't even know how to do that right. Other than that, I don't have any strong feelings on the subject. This is not about me. This is about you.